actually hit it today. So thank you all so much for joining us. If you have not been on our WebEx before, for our Veterans in Ag Lunch and Learn series, welcome. A few housekeeping tips before we officially get started. I'm Ann Johansson. I'm helping on the back side of today's webinar. Along the right-hand side, you have access to a chat panel or a question and answer panel. So as we go through the presentation, if you have questions, go ahead and type those in. If you're having trouble with sound, anything like that, I'm there to help you. Just know that as a participant, you don't have access to a camera or microphone, but we can, and you cannot see the other participants. You can see your name, but you can't see anybody else on there. Just kind of a weird little glitch of the WebEx that it shows that you're there and there are other folks online today, but you can't actually see everybody. You can see us, and so we are welcome and happy to take your questions. And with that, I will pass it over to Beth Graybow, and she will introduce today's speaker. Thank you.
Hi, good afternoon, everyone. Welcome and thank you for joining us. I'm Beth Graybaugh. I'm with Veterans in Agriculture, and we are a nonprofit that is based in Urbandale, Iowa, and our mission is to help veterans thrive in agriculture. So if you ever have any questions, connections with resources, or just information, please feel free to contact me. I want to thank Iowa State University for providing the support for this series, and this project is also supported by the North Central Extension Risk Management Education Program as well as USDA. So today we have Tim Christensen with us. He is an Iowa State University farm management specialist, and one of the areas that he specializes in is row crop and cow-calf farm management. So I welcome Tim, and thank you for joining.
Yeah, thank you, and good afternoon, everybody. In my preparation today for the webinar, I just realized I did everything except for move the dogs out of my office. And usually whenever I get on a webinar and the dogs are in my office, a rabbit will run through the yard and cause them into a barking fit. So if that happens today, I apologize. All right. So thanks everybody for joining us, and I'm excited to be here. And anybody that is a veteran that's joining us, thank you for your service. Today's subject is going to be about livestock risk management. So we all know about crop insurance, or most of us know a lot about crop insurance, but there's a lot of tools available for the livestock producer as well that are similar to crop insurance. And we're going to talk about some of those today and how to manage some of that risk. Like Beth said, my name's Tim Christensen. I'm a farm management specialist covering Southwest Iowa. But here's my contact information as we go through this presentation. If you have any questions, no matter where you live, in any part of the state, feel free to drop me an email or a phone call, and we can work on getting that covered and answering those questions. And I really like questions. I know as we go through this presentation, there's a lot of information, and we only have an hour today. I'm going to try to give as much information as I can, but if you have any questions, feel free to type those into the chat box. At the end, Ann will let me know what those questions are, and we'll try to get those answered. And if you don't want to do that, like I said, send me an email or a phone call. And but please send in some questions. If you guys don't send in questions, Ann makes some up, and hers are really hard. So hopefully some other people will have some questions as we go through this. So like I said, there's my contact information. I grew up in Southwest Iowa on a cow-calf operation. Have managed some cow-calf and row crop farms, and been involved in this industry my entire life. So it's an exciting topic and something good to talk, fun to talk about. So I'm going to I say introduction, and some of you might already know about the livestock risk management protection and the livestock gross margin protection are the two things we're going to talk about today. And even if you do know about it, you might not be aware of. There's been several changes in these programs in the last couple of years. I've been working on writing an article on this for a year and a half now, and every time I get close to getting it finished, they come up with some new changes. So I'm hoping they're getting it hammered out and pretty close to finalized. But we're going to talk about those two products and how they work today, how and introduce you to those and why you might use them. We'll talk about a lot of pros and cons about those programs as we go through it, and we'll run through a couple examples of how those might work in your operation. So the first one is the Livestock Risk Protection. And Livestock Risk Protection will protect against declining market prices. These prices are calculated off the Chicago Mercantile Exchange, so they're not, your local prices at the local market, wherever you might be selling your animals. They don't protect you against those prices, but they do protect you against what's going on the Merc. And if there's a significant drop on the board, usually that will affect your local prices as well. So they tend to track fairly closely, not as close as grain, but fairly closely. And the Livestock Risk Protection is a product that's available. It's not identical to a put option, but it's really similar, where we can put a floor or some bottom side protection on that market and leave the upside open. So if the markets increase, we can still take advantage of those increases. We're not locked into a price, but we put in some protection against the falling prices. And the great thing about this is there's no minimum size or number of animals that you have to do this. The only real restrictions on this is they don't want to insure pets, and they do not want to insure show animals. So if it's just your kids' 4-H project, it probably wouldn't apply, but even your smaller operations, getting started or doing something on the side, if you only have 3-4 animals or whatever, you can still do that. We talked about a put option. That's a tool that a lot of larger operations can use, buying a put option, but those contracts are 40,000 pound minimum. So these are great tools for smaller or medium-sized animals. They do allow us to choose up to 70 to 100% coverage levels, so we can kind of select what kind of coverage we want. Obviously, they're priced comparably there. One of the exciting new changes that makes this a lot more appealing to a lot of people is the premiums are due at the end of the coverage level. So you can insure your animals, and you don't have to pay those premiums until after the end of your coverage period. That's a really nice addition that they've made to that, or a really nice change they've made to that. You can purchase this Livestock Risk Protection on unborn calves, which is new, feeder cattle, fed cattle, unborn swine, regular swine, and lambs. I will preface this, which I'm not going to talk a lot about lambs today. There's some stuff going on with the lamb product right now. It's currently not available. There's some FDIC stuff going on there, and I'm assuming there's going to be some changes that come out of that. So we're not going to go into much detail on lambs at the current time, but you can purchase Livestock Risk Protection on about anything else as far as cattle and swine go. When you get into the feeder calves, there is also a distinction between beef, dairy, and your Brahma or your eared animals, eared breeds. There's some different calculations on how they figure those prices to reflect how those markets work different than what the regular beef markets work. You do have to have ownership of those animals within 60 days of the end of your coverage period. So if market, when we go through this, you'll see you kind of pick when you think you're going to be wanting your coverage period to end. If something changes in the market and you decide to sell those animals early, and it's not within the 60-day period, there can be some penalties there, and you could lose some coverage in those circumstances. However, ownership can be retained at the end of the coverage period. So once again, if you have great ideas of feeding some cattle or some pigs to a certain weight and then selling them, and the market conditions change, something changes on your farm, and you want to go ahead and retain ownership on those, you can still take advantage of that insurance coverage you had through the end of your coverage period, and you don't have to sell the animals. You do need to maintain good records. You can be audited. A lot of this stuff is self-certified. You tell them how many animals you have. You tell them what you want to do, and they'll take your word for it for the most part. But you can be audited. They could ask you for proof of ownership. Like on the unborn animals, they might ask for some vet records or some history on your farm to show that you have a good, reasonable. It's reasonable to think that you'll have as many unborn calves as you're trying to cover, and same on swine. So maybe like a vet check from your vet or a preg check from your vet or uh, something like that might be asked for. Um, and especially when you start talking about the unborn animals and stuff like that, you know, if I have a something happen, I lose more calves in the spring than what I was planning on, maybe don't have as many, whatever might happen, you can notify your insurance agent immediately after the loss and get those removed for the coverage, so you're not paying for those premiums at the end of that coverage. These products don't cover death loss. It's simply price protection. We're not insuring the animal itself. We're ensuring that the price is going to stay in where we think it's going to be, and we're putting some floor on that price and trying to protect some of our profits. So you do have to maintain at least 10% ownership in the animals. You know, a lot of cases in swine and beef, both, maybe you have a cow herd with your brother or your father or a neighbor, 50-50, you can still insure your portion of the animals. Whether your partner insures his or not is not necessary, but you have to have at least 10% ownership in the animals. And like I said earlier, there's no minimum number of animals. And the other thing, I just want to keep driving this point home. We're not talking about your local price. They're not going to ask you what you sold those for. That has nothing to do with it. It's simply what happens on the board. And we're protecting against lowering of prices on the board and not necessarily at your local market. So let's start breaking it down a little more. We're going to talk about feeder cattle first. We can cover calves, steers, heifers, predominantly Brahma cattle, predominantly dairy cattle, and unborn calves. We can insure a maximum of 6,000 head per endorsement period and 12,000. Should be 12,000. I missed a zero there. 12,000 head per year limit, and their year goes from July 1st to June 30th. So there's no minimum, but there is a maximum, and that's the maximum number you can endorse. And like I said, covers about anything we could ask to cover. There's two ending weight ranges. When we start talking about when we're going to sell those calves, we have to decide if we think they're going to be under 600 pounds or from 600 to 900 pounds. And endorsement lengths, there's quite a range there from 13 to 52 weeks of how long we can cover those animals. So typically we know we're going to have some calves or we're going to buy some cattle. Maybe we already have them owned. We kind of look at when we think we're going to market them. We count back at how many weeks that is and pick which insurance period fits that best. And this particular on feeder cattle is available in all counties and all states. So if you're not in Iowa and happen to be listening to this, it is available in other states as well. And I should go back and say too, these are RMA products, similar to crop insurance. They come through the USDA's Risk Management Agency. So when we talk about these, we're going to talk about some prices and how those work, and those prices are set by the RMA, and you work through a insurance agent, but those prices are already set. So it doesn't necessarily matter which insurance agent you work from as far as a price standpoint, but it does in service and that type of stuff and somebody you want to work with. So that was feeder cattle. If we're talking about fed cattle, animals we're thinking about taking to market weight. We can cover steers and heifers as well. Expected ending weights on those need to be between 1,000 and 1,400 pounds. Once again, we've got a 6,000 head per endorsement period maximum and a 12,000. And once again, I missed my zero. 12,000 head per year, and that year goes from July 1st to June 30th. Available endorsement links are the same thing, and once again, this is available in all counties in Iowa. The other one we talked about was swine. It can be purchased on unborn animals. So if you're a feral finneries operation, or if you're buying feeder pigs and finishing those out, you can cover them either way. The limit on those is 40,000 head per insurance period, 150,000 head per year limit, and available in the same endorsement lengths as the cattle for 13 to 52 weeks. It's available in all counties in Iowa, but it's not available in all counties in every state. So once again, if you're outside of this, outside of Iowa, you need to check with the RMA website and see if it's available in your county. And these prices for swine are calculated off the USDA Agricultural Marketing Service data to come up with those ending values. So I wanted to walk through an example just to maybe, to me, it makes it seem more real. And this is just a cut and paste right off of RMA's website. It's a few days old, so these are updated daily and new prices are available daily. So if we look at this, I'm going to use an example of some unborn calves. If I had a cow herd, it's a timely time of year. I'm probably starting to calve already if I'm spring calving or maybe getting ready to. We can look at those calves and say, hey, I want to see what is available for this price protection. And currently, right now, at the 100% coverage level, it is $162.397. So, sorry, I didn't mute my phone either. At the 99.93% coverage level, my coverage price is $162.29 per hundredweight. Then I can look down there on these unborn calves. I think my endorsement leak was 39 weeks. I kind of look back. Cow herd I'm currently involved in, we usually sell around the end of November. So this ending date with the 39 weeks takes me till December 1st. So that was the closest to mine. So I went and picked the 39-week endorsement length, and I can look down there and look under the coverage price column and see what price I want to protect. And the cost per hundredweight over there, the third from the left or from the right, shows me what they cost, what it's going to cost. So I can kind of look around there, see what I feel most comfortable with on the prices and that type of stuff. These premiums are subsidized, and we'll go through that later. But when you're looking at this sheet, understand that the cost per hundredweight over on the right is not yet subsidized. So it'll be cheaper than that. But as I look at that, I decided for this example that $153.89 per hundred, or $1.54 a pound basically, would cover my costs. That's what I wanted to protect against. So once again, we're buying a floor on this. So if the price is above that, I can still take advantage of that extra price. I'm not locking in a price here. I'm just putting in a floor or protection on the bottom of that $153.89. As you can see there, just to the right of that, where I have circled, is my coverage level. That's telling me that I'm covering 94.76% of the coverage price. So that's where becomes important when we start looking at subsidies. And like I said, it looks like it's going to cost me about $5.63 per hundred to buy that insurance. So these are my calves. I'm gonna decide I'm gonna pick that 153.89 just for this example, and then we'll kind of walk through a worksheet here first. So I'm gonna say I've got about 50 cows. I've had them preg checked. Maybe I have 52 or 3, knowing that there's a chance I might lose a calf or two. Or I can buy it for all 50 head that I've had preg checked and just let them know after they calve how many live calves I have and adjust that number later. Either way works, but for my example, I'm going to say I have 50 head of cows that I think is getting ready to calve. I'm going to sell those calves in November. and I think they're going to weigh about 600 pounds. So I'm going to go with that 600-pound weight. It's a 100 weight, so it's 600 weights, right? So 600 pounds. And that 153.89 is what I selected for what my coverage level was going to be. So I put that in there, and I own 100% of these. So that's where if I own 50%, I'd put 0.5 there, or 25%, 0.25, whatever my percent of ownership is, that's what I would put there. And I multiply those out to come up with $46,167 worth of insurance, insured value that I'm looking at purchasing there. So I can come down here, put my insured dollar value there, and this worksheet I'm going through is right off the RMA website, so you can go get that there, and I have those websites later in the presentation where you can see that. So that's my insurance rate. I got that rate off the page before. What it's going to cost me times my insured value to come up with a $1,689 premium, and this is pre-subsidy. So if you see over on the right there, I have a table that kind of shows you what the subsidies are on cattle and swine. They are different for lambs, but we're not going to talk about lambs today anyway, like I said. So for the subsidy level I picked, which was under 94.99, it was 94.87. So that tells me I get the 40% subsidy rate. So I can put my premium here times my subsidy rate to show you that I would pay, I would be getting $676 in subsidies to help me pay those premiums. So if I take my $1,689, take out my $676 of subsidies that are being at 40% that's being paid for me, it would cost me $1,013 to purchase insurance on these 50 head of calves, guaranteeing me a minimum price of $153.89 on the board. So $1,000 on 50 head. We can break that down pretty quick. It'd come up to about $20.26 per head it would cost me for that insurance. Or if I truly sold 600-pound calves, it'd cost me about 3.4 cents per pound when I went and marketed those animals. So in this case, every day that the markets are open, USDA posts what the actual ending values are. So on December 1st, I would go look at that. If it was below 153.89, you would take 153.89 minus that number and come up with my indemnity. If it's over 153.89 that day, then I would not receive any insurance indemnities at all. So I would just be out my $20.26 per head. So I guess where I come up with the real value on this product and why I would use this product, it all comes down to everybody's individual operation, but I always ask how much risk can you handle? If there is a major failure in prices and things really drop off, how is that going to affect your operation? And if it's going to break you and really harm you, this insurance might be some good peace of mind. Also, if you're working with a lender and borrowing money to buy animals and that type of thing, having some insurance in place is going to make them feel a lot more comfortable in loaning you that money. So I guess at the end of the day, like I said, this is helping protect against those things. And we don't have to think very far back in history to think of some things that have happened, as far as mad cow and coronavirus and a lot of other things have happened that we've seen some substantial loss in the markets. And this is a good way to protect your operation against those and go ahead and have some insurance bought to protect you against those things. The other thing I wanted to mention as far as veterans go, if you are a veteran within your first 5 years of an enterprise, having cattle, swine, whatever, you can add 10% to all these subsidy levels. So if you were at 95 to 100% and a veteran within your first 5 years of farming, you'd be subsidized at 45% instead of 35, and so on as we go through there. So if this is something you're interested in when you're talking to and you're newer to farming, it's also available for beginning farmers and ranchers. So anybody that's been farming for less than 5 years, there's some pretty healthy benefits in these coverage levels and increased in subsidies to make it a little more appetizing and for you as well. They'll also waive any administration fees that might come when you go through this process along the way as well. So definitely worth mentioning when you're talking to your crop insurance agent and seeing if you qualify for those. So the next thing we're going to do is move on to the other product we talk about, which is livestock gross margin protection. So the risk protection, we were simply protecting against price. Gross margin goes a little further, and we protect against price loss as well as increase in feed costs. So we come up with a gross margin, expected gross margin on the animals, which we basically take what the market value of the animal was minus the feed cost and the cost of the animal, and try to come up with what we think an expected gross margin is going to be, and give you an opportunity to purchase an insurance to protect that margin. Once again, those prices are based off the Chicago Mercantile Exchange, not particularly the prices you receive, and that goes both for your cost as well. We're making assumptions on what your feed costs, we're making assumptions on what the animals cost, and we're making assumptions on what the value of the livestock is, and not necessarily using your actual numbers, but it's still a good way to protect yourself against rising feed costs as you go through the marketing year. So these premiums, once again, another change they made in these two is they're due at the end of the insurance period. It's a little different. The livestock risk protection insurance we talked about earlier, you can buy that every day. The livestock gross margin protection you can buy 12 times a year. You buy it at the end of each month. Going forward, the sales period is from the last business Friday of each month until 8 p.m. Central Standard Time the following day. So those are the 12 times a year you have an opportunity to purchase this insurance. There is no minimum on this, similar to livestock risk protection, but you have to have 2 marketing months to receive subsidies. So if you just have one animal, the subsidies wouldn't be applicable. If you got a couple different animals, you need to market those in 2 different months to be able to receive those subsidies. And you must have some kind of sales records when you sell those animals to be able to receive any indemnities. So if you're selling them private or something, you need to make up some type of an invoice or figure out a way to record that those animals are sold, and you must provide those records to be able to collect any indemnities. So these are available on cattle and swine as well. So we'll break down cattle first. You can be purchased for an 11-month period. So whenever you buy gross margin protection, you cannot sell any animals in the first month after you purchase that. You have to at least wait till the second month. You can choose from a $0 to $150 deductible in $10 increments. Like I said, they're subsidized. They range from 18% to 50% of those premiums are subsidized. And when we start figuring feed costs, we make an assumption that we're going to use, on calves, we're going to use 52 bushels of corn. On yearlings, we're going to use 50 bushels of corn to finish those animals out. And like I said, it begins 1 month after the policy is approved. So you purchased that policy, you can't take advantage of that in the first month. You have to wait till the second month after you purchase that before you can start selling animals. Swine, we're talking about a 6-month insurance period. The deductibles on those are anywhere from $0 to $20 in $2 increments. Once again, they're subsidized at 18 to 50%. they break it down into 3 categories: farrow to finish, feeder to finish, and the early wean, the SEW operations, which are the early wean, when we're bringing in those 18 to 21 day old pigs. When we figure feed costs on those, and that's why there's a distinction between those, we're using 12 bushels of corn and 138.55 pounds of soybean meal for the farrow to finish, 9 bushels and 82 pounds of soybean meal on the feeder to finish, which the feeders, we're looking at 50, 60 pound feeder pigs, and finishing those out. And the early wean pigs, we're figuring 9.05 bushels of corn and 91 pounds of soybean meal. So you have to identify what type of an operation you are when you purchase that, and then those are calculated off those things. So we talked about those subsidy rates, and just to try to make it a little clearer, I built this chart on cattle. When you pick your deductible, whatever your deductible you pick, then that determines what your subsidy rate would be on there in $10 increments, and the same on swine in $2 increments. Once again, if you're a veteran or a beginning farmer, you can add 10 points to all those subsidy levels in your first 5 years. So there's a nice benefit there for those circumstances. So to kind of walk through this example a little bit, in this case, I used a farrow to finish operation. The 1st of March, I purchased this insurance. This is what it would have cost me the 1st of March to purchase this. I couldn't sell any animals in March, but April, May, June, it's a 6-month coverage level, so I'm asked to select how many target marketings I have in each month. There's no minimum, but we all feeding animals, we know they all don't grow at the same rate. So in my example, I'm going to walk through. I just kind of said I'm kind of looking at one sow, thinking I'm going to have 10 pigs, and I'm going to sell 5 of them in July and 5 of them in August, is just the example I came through, but you can look at your target marketings. Whatever your operation is, you got to kind of think of how many pigs you're going to sell in each month, and that goes different rates. So with that being said, looking at this here, it tells me that they assume a gross margin of $87 per head in July and $86.65 in August. So then down below here, you can see this chart, and I just put this in here to try to make it a little more clear on how this all works. When they look at that and you sell your pigs, let's say in August, down here at the bottom, they're going to look at the August lean hog price on the Chicago Board of Trade. Then they're going to look at what corn was they averaged the last 3 closing days in the month of May, and soybean meal, they averaged the last 3 trading days in the month of May. And this is for farrow to finish. They look back 3 months on corn and soybean meals and use the current hog price on the board when they figure out what the actual margin is going to be, to see if you're above or below that 85-65, to whether there's an indemnity or not. If you were talking about feeder pigs or the early wean pigs, they look back 2 months on corn and soybean meal. So you still use that August hog price, and we look back at corn and soybean meal the last 3 trading days in June as opposed to May. So it's the big difference there on whether you select whether you're a farrow to finish or a feeder and SEW pig. Just depends on how much corn and soybean meal they're going to use and what months they're going to use. So in this example, I look at here, I got to decide, here's what the guarantees are. I got to decide what I want for deductible. So I can say 0 and take the full 85-65, or I can lower that in $2 increments and lower those numbers by $2, and this changes the premiums and the subsidy values when I do that. But we use that 85-65 in our example, and we're just going to assume we're going to take 100% of it and not have a deductible, which is perfectly fine. So when August rolls around, I sell a pig in August, and they're going to look at what the Chicago Board of Trade lean hog prices are. And obviously $45 is quite a bit below where it is right now, but if we buy an insurance, we're wanting to protect against a major price failure. So let's say that went down to $45 between now and August. You know, there's lots of circumstances that can happen. We're protecting against a drop in prices and increase in feed prices, but we look at that and say we sold them for $45. That's a lean hog price. So to bring that back to a live hog basis, we got to take it times our yield factor of 0.74. That's what the USDA uses. And then we can take that time where they assume that your pigs are going to weigh 260 pounds. Once again, when you sell them, it doesn't matter what they weigh. We're making these assumptions to come up with what these might be. They're using 260 pounds. So we take it times 2.6 hundredweights or 260 pounds. And we say that we're going to get $96.20 for that pig. Feed price, looking back at those, and this was a farrow to finish operation I used. So once again, they'll look back at those May corn and soybean prices. I made some assumptions there and said corn was going to be $6. I think I used, I don't remember, $400 or $500 for soybean meal, kind of whatever the May futures look like is what I used. But they'll look back at whatever May futures were in August. And with that calculation, I came up with $30 in feed, which put my actual gross margin at $66.20. Remember, I guaranteed $86.65, so that I would receive an indemnity payment of $20.45 per animal if there was a major price decline, dropping those swine down to $45 lean hog price on the Chicago Board of Trade. So there is a margin calculator or a premium calculator available on the RMA website. It's a little too convoluted to try to walk through, but I can tell you I ran this scenario as buying these through the calculator, and my premium would come up to $8.70 per animal using that 18% subsidy rate for that 0% deductible. Like I said, as that deductible, if I would have lowered this down, my guarantee down by $2, that would increase that subsidy and the deductible would have went down as well. So, like I said, that's kind of a quick summary, and we only have an hour today. I could probably spend 2 hours on each one of those products to go through them and do them justice. But the next question is, where can I purchase these products? Any approved risk managed agency agent. So basically, it's just like your crop insurance agents. Most of them, or some of them, have also are livestock insurance agents as well. If you don't know any crop insurance agents, if you do know some crop insurance agents, I would talk to them first. If you already got somebody you're working with on crop insurance, see if they are authorized to sell these products. If they're not, you can go to this website and put in your address, and it will give you a list of all of the agents that are somewhere close to you that would be available to sell these products. There's lots of resources available. These are all from the RMA website. There's some fact sheets, some worksheets like what we walked through earlier before on all those things. I also gave you the gross margin cost estimator, so you can put your scenarios in there and look at what some of those premiums would be for those products. I can also give you a shameless plug, and I didn't put them on and write them down, but there are some Ag Decision Maker files. If you're familiar with Iowa State's Ag Decision Maker, I can tell you that those files are currently in the process of being updated with the new rules, so that's why I didn't put them on here yet, because they're not done, but I hope to have those done here in the next couple, 3 weeks as we move forward, getting those all updated with all these new rules and premium levels and subsidy levels moving forward. So You can also look at Ag Decision Maker here in the near future and find some articles and some more examples on there as well. So, couple things I always like to talk about in all my presentations is farm stress and everything going on, especially in the veteran world. This is a real issue out there, and something we need to be concerned about. So I like to bring some resources to my presentations to show you. And the number one we have is the Iowa Concerns Hotline. It's been around since 1985. It's free. It's available 24/7. It's confidential, and they have people there that can help you with all stress-related concerns. Financial, legal, family, all those things are covered there, and they have people there that can help you with those things. Because a lot of times we see those things go together. When one thing starts causing us a lot of stress, it can put a stress on other parts of our life and cause some issues. So if you know somebody that's having a tough time, or you're having a tough time, make sure that you know this is available. And I always say, we all might be fine, but we owe it to our communities, our friends, our neighbors, our family members, our community members to look out for one another. And if you see somebody that needs some help, here's one place you can direct them to start that process of getting some help. A couple other programs I always like to talk to is one is the Question, Persuade, Refer program, especially if you're an ag professional working with people every day. It's a program that I'm really excited about. It's a 1-hour online class to help you be able to respond to somebody that is having some issues and needing some help with mental health or stress or something like that. It's a good program, short, quick, 1 hour to really help you be more prepared. I always say we never know when and where we're going to run into a situation where somebody's going to need some help, and here's a program available to make yourself more prepared if that happens to you. And if you're really interested in this subject and want something more in depth, we also offer the mental health first aid. It's a 6-hour online course. Hopefully we can get back to doing this in person. It's 8 hours in person. It's pretty intense, full of information, but you'll walk out of there a lot better prepared to handle those situations. And their websites there available. And both of the Question, Persuade, Refer program is free. And if you are involved with agriculture at all, you can put in AgPro as a promotional code, and you can take this mental health first aid class for free as well. So I know I'm way ahead on time, but nobody's ever upset when you get done with a meeting early, and I wanted to give plenty of time for everybody to ask questions, because I probably created more questions than I did answers in that program. So I'll ask our friend Ann to come back on and see if anybody had any questions in the chat box. If you do not have any in there yet, please put some in there. Said Ann's tough. I don't want her asking me questions.
So your threat worked, because I do have some questions too.
Good.
He's like, oh, well. So first question came in when we were talking kind of about halfway through about LRP. And let's say you purchase 10 open yearly heifers. Is there a plan for the breeding side if 8 would remain open after the breeding period?
Okay, so I'm assuming we have 10 heifers that we're breeding. We want to buy some protection to sell those open heifers if they do not breed. You could do that. Yeah, you can do that, because you do not, on the LRP, you do not have to sell the animal, so you can retain ownership on them. So you could purchase that product on all those heifers. You do not have to sell them. So even if there is a price decline, you could still receive that indemnity and cover both the pregnant and heifers that were open that you turn around and sell.
And then I'm thinking through this, you mentioned about you could make some adjustments for death loss through the period. So if you had intentions of selling those calves and then it turns out that the heifers were open, would you just make an adjustment?
Yeah.
Or would you already need to know that they were pregnant?
You would need to know they were pregnant, so you wouldn't buy that product until after you had done your preg check, because and it's a typical RMA. You don't have to provide those breeding records or proof of pregnancy when you buy the insurance, but they could ask you for it. So, it's a self-certification. You say that they're bred, and when you're purchasing the unborn animal insurance, you are purchasing that for pregnant animals. So yeah, you wouldn't purchase that until after you verified pregnancy.
Okay. Then my next question is, these products aren't heavily used, but when we think through kind of the risk management plan on a livestock operation, and you did mention a little bit, often there are things we have come up. Are there certain situations where you would see a producer might consider this when they haven't in the past? And you kind of mentioned, but I just didn't know if there's other things that
Yeah.
maybe.
Well, like I said, there's been a lot of changes. It used to be a flat 13% subsidy rate, and you had to pay for the insurance on the front side of the insurance period. So they're doing a lot of things to, they're adding to the carrot, right? They're trying to incentivize these more and more to get more people to use them. But I really see these in a place, especially somebody just starting out, a smaller operation that doesn't have the ability to take on the risk. Even if I'm buying some feeder calves and feeding them out, what happens if there's another case of mad cow, God forbid, or something? Is it going to completely break me, and I'm going to start putting myself in some real financial concerns? This would be a great product to turn around and help give you some protection in case that happened. And like all insurance, we don't buy car insurance hoping we're going to go out and wreck our vehicle, right? We hope we're going to not have to use that insurance, and that's usually the best case scenario. But it's just having that peace of mind and protection there against those catastrophic market events that might hit at the time we're getting ready to sell, and could be really crippling to an operation. So this would be a good way to protect against that.
Next question is, USDA has some livestock disaster programs that some do cover death loss and related issues. Some of those use crop insurance records from USDA. Does that hold true with the livestock products as well?
The Livestock Indemnity Program, or LIP, as RMA likes to all their acronyms. So it covers, and you don't have to go in ahead of time like your other insurance stuff. But if you do have a major death loss due to a storm or something of those nature, and that's another whole program we could go into. But in those cases, all you need is usually they ask for necropsy reports to prove there was a death loss and what that death loss was from. And there is some government assistance through that LIP program through that. But you don't necessarily have to prove ahead of time that you have the animals. The necropsy reports pretty much prove that you had the animal, because now you have a dead one. So.
Yes. And then unlike crop insurance, these programs are available for purchase throughout the year, right? So the last option to purchase the price protection could be 13 weeks prior to marketing, right?
Yes.
And
13 weeks.
As you get closer to that, does the premium go up?
Yeah, I mean, well, actually the premium goes down because there's there's less risk of major changes. We know more, or we feel like we know more what's going to happen closer than what we do further away, right?
Yeah.
So when we start looking out a year, we're really guessing, so there's more risk involved, so the premiums would be higher. But yeah, the Livestock Risk Protection is available every day that the markets are trading, and the Livestock Gross Revenue Protection is available the last Friday of every month. So.
Okay. So those are, I think, those are the questions.
Thanks for the questions. That bailed me out.
I will say lots of really good links. And so rather than putting those all in the chat box, I think it works better now. I'm learning all the time, right? Beth will be sending to all the registrants for today's webinar the link to the recording, the materials as far as the handout, and then also it'll have all those links so that people have those handy. They didn't have to save any of those or look them up. Know that you'll be getting those straight from Beth later on.
Yeah, and 1st of May, check out Ag Decision Maker, and there'll be those will be updated as well. So
yes,
I've been working on it. Every time I get this close to finishing it, Ann knows this. Every time I get it approved and get ready to hit send, then RMA sends out another changes to the program. So I'm hoping this was the last one. I think they're close to being done. So
we're gonna try, right?
Yeah.
And so with that, I don't have any other questions. So Beth, do you have any last comments before we close out today's session?
No, I don't have any. other than to thank you for assisting with the webinar and to thank Tim for providing all this great information. I know that I learned a lot from it today. And then also to let everybody know that next week we're going to be having speakers that are going to talk about beginning farmer loans and some of the associated programs related to that. So hope that others can join.
Yeah, and hopefully it's still up there. I think it is. I put my information back up there again, and Beth will be sending that out. If you have more questions on this, feel free to give me a call or shoot me an email. Like I said, it's a lot of ground to cover in the short time that we had. So, but hopefully I at least piqued people's interest, and they'll go out and look for more information.
Thank you both so much. So with that, we will see you next week. Have a good day.
All right.
Thank you,
you.
everybody.